Stop waiting for a housing crash that is not coming. Because in Seattle, the biggest surprise of 2026 is not a collapse, it's stability. For the last 3 years, buyers have been in reaction mode. Rates shot up really high, prices whiplash, and inventory basically disappeared, and everyone froze. But now, the numbers tell a completely different story. Mortgage rates have finally come back down to the low 6 range. They're not 3%, but they're still no longer swinging widely week to week. And at the same time, the median home price in the city of Seattle has settled around $780,000, reflecting roughly 5% in dip year over year. But that's not a crash, that's normalization. We are officially out of reaction mode and back into decision mode. Today, I'm going to show you exactly why 2026 isn't about fear, it's about strategy. Let's start with inventory, because the inventory tells the truth about leverage that you have in the market. Right now, total housing supply across Seattle is sitting around 2.8 months of inventory as of January. And to give you context on what this really means, 0 to 2 months is a strong seller's market, 3 to 5 months is a balanced market, and 6 or more months is really a buyer's market. So when we're sitting at 2.8 months, we're technically still leaning towards sellers, but here's where it kind of gets interesting, because when you break that number down by property type, the story really changes. Residential resale single family homes, so they're not new, is at about 1.4 months of supply, and that is really tight. That leans towards a seller, which means that detached homes in strong neighborhoods in Seattle are still holding value and still commanding attention. But when you look at condos, we're closer to 4.1 months of supply, as well as new construction, roughly 5.4 months of supply. That's approaching, if not balanced, even tipping towards buyer leverage in certain submarkets. So if you're a buyer only shopping single family homes in like Ballard or Green Lake and wondering why it still feels competitive, it's because it really is competitive. But if you're open to townhomes or condos or maybe a new build, you have negotiation power that did not exist in 2021 or 2022. Now, let's layer in the bigger macro picture too. One of the reasons Seattle hasn't seen a crash is wage resilience, especially in the tech sector. While hiring has definitely normalized compared to the pandemic surge, we're no longer seeing Amazon hire as much or Microsoft, the high income workforce that drives Seattle's housing market remains strong, and wage growth over the last few years has helped soften affordability constraints even at these higher mortgage rates. So to say this a different way, we didn't have forced selling, we didn't have over leveraged homeowners, we don't see that in the data, we didn't even have oversupply. We had a rate shock, a mortgage rate shock. And now that rates have stabilized, the market has stabilized with it. And this is why prices dip modestly instead of collapsing. And this is why 2026 rewards smart positioning and not panic. So let's talk about strategy. For buyers, you have to stop shopping based on the list price and start shopping based on monthly costs. Because here's what matters most and something that buyers misunderstand. A 0.5% shift in the interest rate on an $800,000 home, for example, can change your payment by roughly $250 to $300 per month, depending on how that loan is structured. And that's the difference between stretching your budget or staying comfortable in a month-to-month payment. So instead of obsessing over whether you missed the bottom of the market, really what you have to do is focus on monthly comfort zone. If you are a buyer who is sensitive to the rates and how much that changes your monthly payment, maybe you should explore condos that offer seller credits, which is a great option. And then new construction also offers buy down incentives for buyers. Adjustable rate structures could be a good idea if you plan to refinance in this market, and maybe you want to leverage, but only if you know where to look. New construction also is offering buy down incentives for buyers. You could think about adjustable rate mortgage structures if you plan to refinance. But in this market, leverage does exist, but you have to look in the right spots. Now, when we turn our attention to sellers, the 2021 playbook is definitely dead. Pricing 8% above comparable homes to leave room for negotiation does not work in this stabilized market. And here's a rule I'm giving every single seller in 2026, 10-10-1. 10 showings without one offer, or if we go 10 days without one showing, the home is most likely overpriced. In a market like this, if you don't have activity by the 14th day on market, you're also probably overpriced. When you have 1.8 months in this resale environment of inventory, serious buyers are moving quickly. And if your home sits, it's not the market, unfortunately, it's the price. But the good news is a well-positioned home is still selling. Presentation, pricing, and early momentum matter more than ever because this isn't a market that is frenzied anymore. It's a professional market. And those professional markets, they reward preparation by sellers. So what does all this mean? Here's the bottom line. 2026 does not reward inventory hoarding. It rewards intelligence. Buyers who understand leverage can win, and sellers who price strategically can also win. Investors who track that sub-market data we discussed also win. And everyone else might be waiting. They might miss the timing. The crash that people predicted never came. Instead, we got something healthier. We got stability. So there are leverage pockets, there are negotiation opportunities, and there's realistic pricing that's not scary, that is workable. So here's what I recommend if you're a buyer. Figure out your payment comfort first. What's that month-to-month number? Then let's identify which property category gives you that leverage you need. And if you're a seller, let's analyze your micro neighborhood, not just the city median, because pricing strategy in some place like Capitol Hill is very different than Magnolia. And if you're just watching the market from the sidelines, understand that waiting is still a decision that you're making. So if you want a tailored breakdown of your specific neighborhood, not just what you see in the news and on the headlines, DM me the word strategy or click the link below for a free discovery call where we can look at how much equity you have in your home, what your buying or selling timeline looks like, the neighborhood absorption rate where you're looking or where you want to sell, and how to leverage your options. We're not going to look at hype, we're going to look at data and strategy, because in 2026, the winners aren't the ones who guessed right, they're the ones who planned the right way. So I hope you enjoyed this video. If you want more like this, be sure to like and subscribe and send this to someone you know who's thinking of buying or selling in 2026. Hopefully this data is going to help them understand how to be smart in a stable market.